Hey everyone, it's Sean from Predicting Alpha. In today's video, I'm going to show you how I'm trading options around NVIDIA after their stock split. So back on July 20th, NVIDIA did a stock split. So for every one share you held in NVIDIA, you now have 4 shares. And let's say the stock was trading at $600, it's now trading at $150 a share. Now, the cool thing about an event like this is that it makes the stock more accessible to retail traders, right? People who maybe don't have the account size where they can justify trading a $500 or $600 stock. Now they're able to come in and purchase the stock at a lower price per share, making them more inclined to actually trade the stocks. On the surface level, the options actually look cheaper as well. So you have a lot more people coming in, driving up the demand for calls and puts. And what we're going to explore today is, has this new demand that's come into the market because of this stock split skewed the value of the options in any way? Or maybe there's some sort of inefficiency we can take advantage of. And what you're going to see by the end of this video is that there's actually a really good trade that we can be putting on here. What we're going to do in this video is break down that trade step by step, all of the research that I did to really formulate a good trading idea. We're going to be following what we call our fund manager method, which is a 4-step process for finding and evaluating trading opportunities so that we can place these trades with confidence. Remember, if you like this video and you find value in the analysis that I'm going to provide, make sure to like the video, subscribe to the channel, and if you want to learn how to trade the fund manager method yourself, you can sign up for Predicting Alpha for free. 14 days, complete access. Just click the link in the description below. So let's get into the analysis. So the first thing we want to do is formulate our hypothesis. What is the inefficiency that we think we're going to find here that we want to try and evaluate? And in this case, because of the increase in retail demand, the lowered share price, I'm thinking that options are going to be a little bit expensive around NVIDIA in, let's say, the next 30 days. So what I'm going to evaluate right now is, are options cheap or expensive for NVIDIA in the next 30 days? Looking at the 30 DTE options. So now let's start trying to price this thing. The first thing we need to always remember is options are volatility products. So when I'm trying to price the options, I'm really going to be focused on what these options are implying to happen in the future for NVIDIA. And first thing I'm going to do is compare to what's actually been happening for the stock. So the first graph we're going to use here is our implied vol graph. And check this out. Let's come in on 1 month here. What we can see is that the implied vol for 30-day options has increased in the last 20 days or so from 39 up to about 43.5. So we've seen about a 10% increase in implied volatility. And over that same time period, we've seen realized vol float around the 35 to 38 mark. What this tells me is that there might be some sort of risk premium baked in here that we could go and harvest. You can see that the value of the options has been steadily outpacing the realized returns of the stock. This is a good indicator that there might be some sort of trade here where we can come in and sell these options. Right? Imagine if we sold at this green line and the stock realized this blue line, we would make that difference. So for my first little piece of the analysis here, I'm thinking those 30-day options are in line with our view that they might be a little bit expensive. Next thing I want to test is, have we actually seen an increase in volume for these options? And since it's in the retail space, I'd expect to see a lot more call action, right? A lot of people coming in, bidding up those call options. So I'm going to open up my volume scanner here, and we can see the option volume over time for NVIDIA. And take a look at what we see. For today, we're actually seeing the highest call volume that we've seen in a long time, right? Let's take a look at year to date. We're basically all-time high call volume right now, significantly outpacing the put volume. Now, does that make sense for a company the size of NVIDIA? Probably not. We wouldn't expect to see such a huge discrepancy between calls and puts. A lot of funds hold this company, for example, and it would make sense that there's a lot of put volume too. So this indicates to me that we are seeing that increase in retail demand coming in, right? Message volumes at all-time highs on StockTwits, on Reddit, and we're seeing that call volume that indicates to me a lot of retail action coming into the market. I consider this to be a really good thing for my analysis because we are coming from a value perspective here, trying to evaluate these options and say, what should these things be priced at? Most people are just coming in looking for that directional edge, saying, give me that leverage. We're coming in trying to price it, so hopefully we'll be able to make a better decision than the average person, and that's what it takes to make money in this game. So let's summarize what we've covered so far for NVIDIA. The implied volatility has been outpacing the realized volatility for about the last month or so. Even with the stock split, we haven't seen the realized movement of NVIDIA break through the implied movement of the options, meaning historically, these options have been pretty expensive, and we would have made money selling them. Looking at the option volume, we can see a lot of call demand coming into the market ever since the stock split. And this really coincides with that view we have that retail traders are driving this new demand coming in for NVIDIA. Stock price gets lower, people with smaller accounts can start to come in, message volume all-time highs across social media, call volume all-time highs. I think I have a good idea of who's on the other side of my trade here, and it's probably the average investor. So when I put all these together and try to paint a picture of what's happening with NVIDIA here, it's pretty clear to me that these options are looking a little bit expensive, really leaning towards selling something like a straddle here over the next 20 to 30 days. Before we actually formulate our view completely, there's one more form of analysis that I want to engage in with you, which is a relative value analysis. Now we have an idea that NVIDIA is a little expensive relative to what it historically is priced at. But what would be interesting to know is, how is NVIDIA priced relative to another correlated stock, right? Maybe how is NVIDIA trading relative to a company like AMD, which is a similar company to NVIDIA with similar volatility? So let's go ahead and do that now. Let's actually see if AMD is a good comparison. So what we can see here, what I've done is basically plot NVIDIA and AMD and taking a look at the rolling correlation between the two. And we can see that these stocks are about 70-75% correlated. So we should see these things trade pretty similarly to one another. So let's go a little deeper here. I'm going to do a relative value analysis where let's start off by plotting the relationship between NVIDIA implied vol and AMD implied vol. So this is really cool. You can see that the relationship between options for NVIDIA and for AMD have a mean reverting process, which means they move together, and whenever they get too far apart, they come back together. And you can see that here by looking at the ratio between the IVs for each company. Now what we can also see here is that the average IV is probably about a ratio of 0.9, where for every 1 point of IV on AMD, we see a 0.9 point of IV on NVIDIA. So AMD IV is usually a little higher than NVIDIA's. But in this situation right now, where we are today, the ratio is 1.1, which means that for every 1 point of IV on AMD, we're seeing 1.1 point of IV on NVIDIA, a little bit higher than the average that we normally see. So this is kind of supporting our hypothesis that NVIDIA vol is looking a little bit expensive. Now here's the thing though, we have one more piece of the analysis that we need to do to be able to say that relative to AMD, NVIDIA is a little bit expensive. If NVIDIA volatility had gone up, but so had the actual movement of the stock, it would make sense that we see that deviation. So what we're gonna do now is plot NVIDIA's IV over RV and compare it to AMD IV over RV. So basically, instead of just looking at the implied vols for each stock, we're gonna look at the relationship for market implied vol and realized vol for each stock compared to each other. So if the spread for one stock is different from the spread for another stock, there might be a trade there. Let's go ahead and try and figure this out. Now I know that's a little tricky at first to really process and include in your trading. That's why I included with the PA Academy and with our terminal is a ton of education that makes it easy to do these forms of analysis. But bear with me here. We'll try and draw some pretty cool conclusions. Okay, check this out. So the green line is the AMD IV30 divided by AMD RV30, and the blue line is NVIDIA IV30 divided by RV30. And what we can see here is the NVIDIA IV-RV ratio is higher than the AMD IV-RV ratio. This tells us that not only has the IV increased for NVIDIA relative to AMD, it's done so without an increase in realized volatility for NVIDIA. Let's make it really simple. The stock isn't moving any more than usual, but the market is starting to imply that the stock will move more than usual. This is happening because of that increased demand coming into the market. All of the retail traders piling in, buying those calls, right? We come back over here. We can see call volume through the roof, all-time highs. And this really solidifies for me that NVIDIA volatility is looking expensive. So what is my view here, right? Now we've done step one and really step two. We created our hypothesis. We've done our analysis. We did an absolute value analysis. We did a relative value analysis. And what's left to do is formulate our view and structure out a trade that expresses it. So given the analysis that I've done, what do I think about the following, right? We'll talk about each of the Greeks, right? Our deltas, our gamma and theta, and our vega. Well, I really don't have any view on direction here. I don't know if this thing's gonna go up or down, but that's totally okay. All that means is when I put on my trade, I'm gonna try and make it delta neutral, meaning I have zero exposure to a change in the direction of the stock. How about for gamma and theta? The easiest way to think about your gamma theta exposure is, do I think the stock is going to move more or less than what the market is implying in the near future? Let's call it the next 15 to 20 days. Well, given what I'm seeing on the IV here and what I saw in my relative value analysis, and knowing that retail traders are the ones coming in and buying up all of these options, I'm thinking that the stock will realize less volatility than what the market's implying, which means I want to have negative gamma and positive theta, right? So I probably want to be short options here. Finally, I do think the level of implied volatility is a little bit high. And the reason I think that is because of this initial analysis that we did, where we see that the implied vol for NVIDIA relative to AMD is a little bit on the high side. So I think that we could see a couple point drop in implied volatility here, which means I want to have some of that negative vega exposure. So I want to be delta flat, theta positive, gamma negative, vega negative. So let's go ahead and structure out a trade that has those exposures, and then we'll talk about how we're going to manage the position. Because NVIDIA has an earnings event on August 18th, I'm going to trade the expiry right before that. I don't really have a view on their earnings yet, so I don't want to include that in what I'm exposed to when I trade. So I'm going to look at this August 13th expiry here. And because I have no view on direction, I'm just going to come to the at the money strikes and structure out an at the money straddle. So the stock's trading at 194. So let's come over here to, let's call it the 195 strike. Right click, sell, straddle. And this should be the trade that we're putting on. So let's take a look at our price slices so we can see what our exposures are with this trade. Always remember, any trade structure just gives you a different exposure in the market. It's really all about what you are trying to express in the market. That's what really matters. The structure is just how you say it. So what we can see here is my current structure at the price the stock is currently at. I have minus 19 delta, so not completely flat, but not a ton of exposure there. Minus 41 gamma, which is what we wanted. 349 theta, positive theta, big number for theta there. I think that's the main part of our trade anyways. So I'm happy to see that big positive theta number on this position. And we have minus 381 vega. So if implied vol starts to come down, we're gonna make money as well. So let's turn those into plain English. We're not gonna make much or lose much if the stock changes in price, but we will make a lot of money if the stock stays within our body over the next 20 days. And we'll make even more money if the level of implied volatility comes down. Now, if the stock starts to move like crazy or implied volatility increases, we are going to start to lose money on this position. Remember, there's no free money here. It's just a good analysis with a good trade idea. And if we are correct, we're gonna get paid. And if we're wrong, then we're gonna lose some money, and that's okay. That's the nature of trading. Right? Two last things we're gonna talk about here. Number one is, well, when am I right and when am I wrong? Right? If we come back to the terminal here, we can see that the 1 day implied move is about 2%. So if the stock moves 1.5% a day, 1% a day, I'll be pretty happy with it. And if it continued to do that, I would stay in the position. I would close my position for a profit towards the expiration. I'd be looking to hold it for the majority of this contract, assuming the stock didn't move much. If it did start to trend, I would just hedge my deltas accordingly. And if it trended up or down maybe 8 to 10%, at that point, I would just close out the position as it's drifted too far for my liking. Now on the losing side, I would close out this position immediately if we saw something like a 5% gap day. The stock gapped up or down 5%, I would just close out the position because clearly I was wrong. And that's okay. It's just what's not okay is holding on to the position once you realize you're wrong. You gotta get out right away and start looking for the next trade. I would also close out if this thing continued to trend at 1.5, 2% a day to one direction. So how much am I supposed to make on this trade? Well, for that, we can just use our price calculator here. So NVIDIA is trading at about $194 right now. So let's put that in here. And we have a 195 strike for our straddle. The expiration is the 13th of August. And the current implied volatility is about 43%. So what we have here is the current premium that we'd be collecting for the trade by about $15. If we take a look here, yeah, we get about $15.25 for it. So let's come in here and put in what we think the stock will actually realize in terms of volatility, right? Maybe about 38%. So let's come back to our calculator here and change that volatility number to 38%. We get a new number here. Our new straddle price is $14.20. So we are going to sell the straddle today for $14 or for $15.25. And if we're correct, our expected value is that this straddle should be worth about $14, $14.20, which means if our view is correct, on average, we should realize a profit of $1 per contract trading this strategy on NVIDIA. Now, obviously, there will be some variance around that P&L, but if we were to take this trade over and over again into the future, and our analysis is correct, on average, we will make $1 per contract trading NVIDIA after the stock split. So that's what I got for you guys today for an analysis. Let me know if you guys take this trade or if you have any questions about this form of analysis. Remember, if you enjoyed this video, hit the like button, subscribe to our channel, and you can always take that free trial at Predicting Alpha if you wanted to take your trading game to the next level. We'll see you all in the next video.